Hello, this is our Case 18 presentation. I'm Brian Sanchez and I'm part of Group 5. So question 1 asks us, if Norton Electronic Incorporated were to raise all of the required capital by issuing debt, what would be the impact on the firm's shareholders? So with this situation, the main differences between the current option and the new cases is that there is now growth in revenues as well as a $500,000 interest expense, which leads to the change in net income. If the EPS grows once it reaches the expected and the best case, but it is less than the current if the worst case happens. With the debt, shareholders have a better chance of obtaining a greater return on equity than expected. The return on equity growth becoming greater than the current is dependent on the growth in revenues reaching past a specified point between 10% and 30%. Now, for question 2, it asks, what does homemade leverage mean? Using the data in the case, explain how a shareholder might be able to use homemade leverage to create the same payoffs as achieved by the firm. So, homemade leverage is a method of artificially adjusting the leverage of a company by substituting their own personal borrowing. Investors who want more leverage can take their own personal borrowings and use it to purchase company stock in place of corporate borrowings. Now, looking at the numbers with no debt taken into account, we see there's no interest in debt taken into account, which makes the rate of return on equity slightly smaller than the first option. Despite this, after adjusting the earnings for after-tax interest, the net earnings in this situation is the same as the situation with the company taking on the debt.
Hello, my name is Luis Medina, and I will be presenting question 3. Question 3 states, what is the current weighted average cost of capital of the firm? What effect would a change in the debt to equity ratio have on the weighted average cost of capital and the cost of equity of the firm? Currently, the weighted average cost of capital of the firm stands at 12.88%. Norton Electronics currently does not possess any debt, and thus we have the current WACC of 12.88%. But if we assume in a different scenario that Norton Electronics does take on debt, this would cause the debt to equity ratio to increase, and this will cause WACC to decrease. On the other hand, the cost of equity will increase. In the new scenario, WACC would fall to 11.59%. So with the company taking on debt, their RE would also increase to 13.45% in the new scenario, and thus this change would cause the WACC to fall to the level previously stated of 11.59%. And just to summarize, debt, the company taking in debt decreases the WACC and increases the cost of equity.
Hello, my name is Carter Haro, and I'm going to be going over questions 4 and 5. Question 4 asks, the firm's beta was estimated at 1.11. Treasury bills were yielding at 4%, and the expected rate of return on the market index was estimated at 12%. Using various combinations of debt and equity, under the assumption that costs of each component stays consistent, show the effect of increasing leverage on the weighted average cost of capital of the firm. Is there a particular capital structure that maximizes the value of the firm? So looking here, we have a little snippet of our debt equity ratio. We can see that as debt increases, our cost of equity, our RE, does increase, and then our WACC does decrease. We can also see that our VU and our VL, our unlevered value of the company and our value levered company, our VU stays stagnant, and then our VL, our levered value of the company, does increase as we increase the amount of debt. And that is also shown in this next slide where we have our imminent proposition 1 with taxes. So that leads us to our next point that if the firm was to increase its debt to 100%, no equity, it would be able to maximize its company value, although that is not really good business practices, let alone not even feasible. As for question 5, it asks, how would the key profitability ratios of the firm be affected if the firm were to raise all of the capital by issuing 5-year notes? So the ratios we chose to do were our net profit margin, our return on equity, and our return on assets. Looking at the net profit margin, we do have a current value of 9%. And then for our projected values based on growth in revenues, for our worst case, which is a 10% growth in revenues, we get 7.18%. Our expected case, which is 30% growth in revenues, we get 7.46%. And then for the best case, which is 50% growth in revenues, we get 7.67%. We can see that currently our net profit margin will be higher, but this is because it does take into consideration net income, which will be lower because with taking on debt, we do have to pay interest expenses. For our ROE and our ROA, we can see that in both scenarios, it is higher than current in the expected case and the best case, but lower in the worst case. This is because at a certain point in between the 10% and the 30% growth in revenues, it does get the current value. So anything above that said percentage in between the 10 and 30% will be greater than the current scenario.
Hi, my name is Tyrosh Gomez, and I'm going to be covering question 6 from case 18. So question 6 basically goes over what do we recommend to the board after all the research was conducted. And since Norton's Electronics has become significantly more profitable and has minimized debt in recent years, creating leverage through debt may be a good opportunity to continue the growth for the company. The next point is utilizing the leverage strategy compared to homemade leverage strategy also gives a better chance to achieving higher return on equity than their current. And the last point is if the board is adverse to taking on the $5 million entirely in debt, it could be recommended to find a suitable mix of both debt and homemade leverage to help ease the worries for the company. And then now we're going to move on to question number 7. And question number 7 is basically just what are some of the concerns that come from increasing leverage? So our first point is rapidly increasing financial leverage can be a sign of vulnerability for Norton Electronics. The next one is interest rates might not be low enough to support current goals. And the third one is business assets used for collateral will be at risk. And lastly, maintaining the amount of debt from leverage may become a problem in the future. And another point that I'd like to gloss over is increasing leverage can also be a sign for investors to maybe stay away from the company because it may be putting on more risk for those investors and they may want to look elsewhere.
Hello, this is Hunter Thompson, and I will be covering questions 8 and 9. For question 8, it asks, is it fair to assume that if profitability were positively affected in the short run due to higher debt ratios, would the stock price increase? And so some of the notable factors we would look at for the stock price of this company would be returns on investments, as well as the different risks taken on by said company. And so for the short run, we would assume that the stock price would increase as returns would be higher due to the short run investors not yet being worried about levels of debt. So although it is good to note, with poor management of debt and high amounts of debt, this can create a high risk in the future. And so in turn, this would decrease investor earnings. You would lose some interest from investors, which could negatively affect the stock price. But that is more for the long run. And since we're looking at the short run here, we would assume that the stock price would increase. And then for question 9, it asked to explain how Clive could enlighten the board members about Modigliani and Miller's propositions 1 and 2. This slide going over proposition 1. Using proposition 1, we see that with the more debt the company takes on, the more the levered value of the company becomes, and this also creates more tax benefit. So looking at the table here, we see the straight line being the unlevered value. So with more debt, though, with the levered value, we see the higher the debt, the higher the value of the firm. And this is with taxes, of course, because with these taxes, the tax benefit would benefit the company, giving it more assets to invest with. And so we would see that with the more debt the company takes on, the higher the levered value is with the taxes. And then continuing with question 9, going over proposition 2, we do conclude that with using proposition 2, that as the company increases debt, the WACC decreases, which allows the company to allocate more funds to investing in the company. So we see here proposition 2, the debt to equity ratio. We see the higher the debt to equity ratio, the RE goes up and our WACC goes down, going from about 13%, dropping a couple percent below that. So we see that as they increase debt, the WACC would decrease and the RB would increase. And thank you for watching.